508 points. Gone. In 6.5 hours. On October 19, 1987, the Dow Jones Industrial Average fell 22.6% in a single trading day. To put that in perspective, that would be like the Dow losing over 9,000 points today. In one day. While you were at work. While you were eating lunch. While you had no idea what was happening. Welcome to Black Monday. The day the stock market learned that computers could destroy wealth faster than any human ever could. To understand how this happened, you need to understand the world of 1987. Reaganomics was in full swing. The American economy was booming. The Dow had risen from 776 in August 1982 to 2,722 in August 1987. That is a 250% gain in 5 years. Everyone was making money. Corporate mergers were the rage. Ivan Boesky and Michael Milken were turning Wall Street into a casino. Junk bonds were the hottest investment on the planet. The phrase "greed is good" was not just a movie line. It was a way of life. But beneath the surface, cracks were forming. The first crack was the trade deficit. America was buying far more from overseas than it was selling. The dollar was weakening. Treasury Secretary James Baker was publicly pressuring Germany to lower interest rates. When Germany refused, Baker appeared on television and threatened to let the dollar fall further. The markets heard that as a declaration of war on the dollar. Foreign investors began pulling money out of American assets. The second crack was program trading. This is where it gets technical, and this is where the real danger was hiding. Program trading meant that computers, not humans, were making buy and sell decisions. These programs were designed to automatically sell stock index futures when prices dropped below certain levels. The theory was simple: if the market fell, you could hedge your losses by selling futures contracts. The strategy was called portfolio insurance. It was invented by two finance professors at the University of California, Berkeley. Their names were Hein Leland and Mark Rubinstein. They had created a mathematical formula that promised to protect investors from losses without requiring them to sell their actual stocks. It worked beautifully in theory. In practice, it was a time bomb. Here is the problem with portfolio insurance. It only works if there is someone on the other side willing to buy. When one computer sells, another computer needs to buy. But what happens when every computer is selling at the same time? That is exactly what happened on October 19, 1987. The crash actually started on the other side of the world. On Friday, October 16, the Hong Kong stock market began falling. By Monday morning, Hong Kong had crashed 45%. The selling spread to Europe. London fell 26%. Sydney fell 41%. When the New York Stock Exchange opened on Monday morning, it was already walking into a bloodbath. The opening bell rang at 9:30. Selling was immediate and overwhelming. The Dow dropped 200 points in the first hour. That may not sound like much today, but in 1987, a 200-point drop was unprecedented. By noon, the Dow was down 300 points. The New York Stock Exchange specialist firms, the designated market makers who were supposed to provide liquidity, were overwhelmed. They could not keep up with the flood of sell orders. At 2:30 in the afternoon, the Dow was down 400 points. Trading on the floor of the NYSE had become nearly impossible. There were not enough buyers. Computer screens were lagging. Telephone lines were jammed. The portfolio insurance programs kept selling. Every time the market dropped another 10 points, more computers triggered more sell orders. It was a feedback loop. A death spiral. And there was no off switch. By 4 o'clock, when the closing bell finally rang, the Dow had fallen 508 points. 22.6%. The S&P 500 fell 20.4%. over $500 billion in market value had been erased. That is $1.7 trillion in today's money. Gone. In a single day. Because of computers selling to computers. The next morning, Tuesday, October 20th, brought something even scarier than the crash itself. The financial system nearly collapsed. At 8:15 in the morning, the Federal Reserve issued a one-sentence statement. The Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system. That one sentence may have saved the entire global economy. The new Federal Reserve Chairman, Alan Greenspan, had been in office for exactly 2 months. He was 51 years old, and he was facing the worst financial crisis since the Great Depression. He made the right call. He flooded the banking system with cash. He made it clear that the Fed would provide unlimited liquidity to any bank that needed it. But even with the Fed's intervention, the selling continued. On Tuesday morning, the Dow dropped another 100 points. The NYSE temporarily halted trading in several blue-chip stocks because there were literally no buyers. Not one. The specialist firms, the market makers who were supposed to always provide a bid, went bankrupt. Kidder Peabody, one of Wall Street's oldest firms, lost $25 million in a single day. 2 specialist firms were wiped out entirely. So what caused the crash? The answer is uncomfortable because there was no single cause. The Brady Commission, appointed by President Reagan, spent months investigating. Their report identified 4 main factors. First, the trade deficit and the falling dollar had made foreign investors nervous. Second, the tax code had created incentives for corporate mergers that were fueling speculation. Third, portfolio insurance and program trading had created a feedback loop that amplified every sell order. Fourth, the lack of coordination between the stock market and the futures market meant that selling in one market cascaded into the other. But the real answer is simpler than that. The market had risen too far, too fast, and it was built on a foundation of borrowed money and computer algorithms that no one fully understood. Here is what makes Black Monday different from every other crash in history. The recovery. After the 1929 crash, it took 25 years for the market to recover. After the 2008 financial crisis, it took 5 years. After Black Monday, the Dow recovered its pre-crash level in just 19 months. Why? Because the underlying economy was still strong. Corporate earnings were growing. Inflation was under control. And the Fed's aggressive response prevented the crash from turning into a real economic crisis. This is the most important lesson of Black Monday. A stock market crash does not have to become a Great Depression. The speed of the policy response matters. Greenspan understood this. He acted within hours, not weeks. But there were consequences. Real consequences. The human toll was devastating. Thousands of traders and brokers lost their jobs. The London Stock Exchange laid off 15% of its workforce. In New York, entire trading desks were shut down overnight. The psychological damage was immense. Traders who had spent their entire careers in a bull market suddenly discovered that the market could go down, and it could go down faster than anyone had imagined. The media was in a frenzy. The New York Times ran a front-page headline that simply read, "Wall Street's Worst Day." Time magazine put a shattered stock ticker on its cover. Television news showed footage of traders standing on the floor of the NYSE, staring at their screens in disbelief, unable to move, unable to think, unable to process what had just happened. The Brady Commission recommended sweeping changes. They proposed circuit breakers, automatic trading halts that would activate when the market fell too far too fast. If the Dow dropped 250 points, trading would pause. If it dropped 400 points, trading would stop for 30 minutes. If it dropped 500 points, the market would close for the day. These circuit breakers are still in place today, updated and adjusted for modern market conditions. In March 2020, during the COVID crash, circuit breakers triggered 4 times in 10 days. They worked exactly as designed. Black Monday also changed how we think about systemic risk. Before 1987, most people believed that a diversified portfolio was safe. Black Monday proved that correlations go to 1 during a crisis. Everything falls together. Stocks, bonds, commodities. The diversification that was supposed to protect you simply vanished. This lesson was forgotten by 2008, when the same false belief in diversification led to the collapse of the housing market. But that is a story for another video. Perhaps the most haunting aspect of Black Monday is what it revealed about our relationship with technology. We had built a financial system that relied on computers to make decisions at speeds no human could match. But no one had asked the question, what happens when all the computers make the same wrong decision at the same time? We are still asking that question today. High-frequency trading now accounts for over 50% of all stock market activity. Algorithms can execute thousands of trades in a single second. Flash crashes, sudden drops of hundreds of points in minutes, have become almost routine. In 2010, the market dropped 1,000 points in 5 minutes. In 2015, the Dow dropped 1,000 points at the open. In 2018, a single algorithm triggered a sell-off that wiped out $1.2 trillion in market value in a single week. The technology has changed. The risk has not. Here is the uncomfortable truth about Black Monday that nobody talks about. The crash was not a failure of the market.